Welcome back, traders. This is Will Duckworth, lead strategist at Narrowgate Trading. It's Wednesday, October 22nd, 2025, and if you'll recall, though my approach to trading Forex is primarily based on the use of moving averages and especially moving average envelopes, I indicated that I use other elements as well, such as support and resistance levels, market structure, and repeating patterns. I also said that I would be touching on these other aspects of my approach in future videos. Well, with that in mind, in today's video, we'll be diving into one of the most timeless and visual concepts in technical analysis that I use. Of course, what I'm talking about are trend lines. Whether you're trading currencies, stocks, or commodities, trend lines can help you read the market story more clearly. But first, let me go over the two main trades I made during the current 24-hour market cycle. The first was a $43 trade I made from my Tradiso Group MT5 terminal, and the second was an $8 trade I made from my Owanda MT4 platform. Each of these short positions was entered because 6-hour and 21-hour price action were both headed south. And with that, let's go ahead and look at how to draw and use trend lines properly, how different professionals approach them, and how they might fit into your trading system. At its core, a trend line is a simple tool, a straight line connecting at least two major price points on a chart. In an uptrend, draw your line along the higher lows. This helps you visualize support as price rises. In a downtrend, connect the lower highs. That's your dynamic resistance guiding you during declines. Trend lines are important because they make trends visible. They show you where the market has respected certain levels and, more importantly, where future price action might pause, bounce, or break. A proper trend line connects two or more significant swing points. For uptrends, focus on the lows. For downtrends, focus on the highs. Don't force your line to fit the data. Let price action guide the placement. The ideal trend line touches multiple points without cutting through too many candles. As new price data appears, adjust the line slightly to stay accurate. Think of it as a visual framework, not an exact measuring device. Trend lines don't predict price. They define areas of potential reaction. Now, let's explore how professional traders like Bradley Gilbert, the founder of Traders, see this tool. Gilbert, who has a background on bank trading desks, teaches that while trend lines are an important technical tool, they're not sufficient on their own. He views trend lines as execution tools used after identifying macro direction through fundamentals, like interest rate expectations or central bank policies. In other words, fundamentals set the direction, and trend lines define the trigger point for entry and risk management. For Gilbert, a trade's strength comes from the alignment between fundamental drivers and technical setups. So, while trend lines are critical, they are part of a bigger decision-making structure. On the other hand, Gareth Soloway from Verified Investing takes a more pure, technical perspective. He focuses on chart geometry and probability-based analysis. Soloway teaches that price charts themselves contain the information necessary to forecast movement. To him, trend lines visualize supply and demand where institutional money reacts. His principle is that the more times price hits a trend line, the weaker it becomes, meaning each touch increases the probability of a breakout. He applies trend lines across multiple markets, not just Forex, using confluence with patterns and candle signals to build a case for high probability reversals or continuations. Unlike Gilbert, Soloway doesn't rely on news or economic context, only on price behavior. Personally, my philosophy lands closer to Soloway's perspective. While I respect Gilbert's institutional background, I believe that market-generated information, technical data itself, is the most trustworthy guide to what traders are actually doing, not what they're saying through fundamentals. In my own trading, I primarily use moving averages and moving average envelopes, a system I call band distribution trading. Trend lines are my verification layer. If my moving averages and envelopes suggest a directional bias, I look to trend lines to see whether the market's actual price structure supports that interpretation. When both agree, my conviction in the trade setup increases. Here's how you can use trend lines effectively in your Forex trading. 1. Identify the trend. Is the market making higher highs and higher lows, or lower highs and lower lows? 2. Draw your trend line. Connect the key swing points. 2 points define a line, 3 points confirm it. 3. Watch for interaction. How does price behave when it nears your line? Are there bounces, breakouts, false breaks? 4. Combine with other tools. Layer it with your moving averages, support resistance levels, or oscillator confirmations. 5. Manage your risk. Plan stops just outside your trend line or behind recent structural points. Remember, Trendlines aren't predictions, they're frameworks of behavior. Use them to structure your plan, not dictate it. By the way, I should probably also mention that Jim Roof, an independent chartist behind a website called SP500CHART, based his chart reading practice on the methodology developed by John McGee, co-author, with Robert D. Edwards, of a seminal work titled Technical Analysis of Stock Trends. Jim recommended that 1948 publication for learning how to draw trend lines, and it is widely recognized as the foundational Bible of classical trend line and chart pattern analysis in technical trading circles. McGee's approach, which Roof evidently drew from, emphasized three enduring principles. 1. Prices move in trends. 2. Volume confirms those trends. 3. A trend, once established, tends to persist until clearly reversed. Large sections of the book teach how to draw and interpret trend lines, channels, and reversal patterns such as head and shoulders, triangles, and rectangles, all supported by real-world price, volume behavior. From what I understand, this classic text has later editions edited by W.H.C. Bassetti. So in conclusion, whether you approach trading through fundamentals like Bradley Gilbert or pure technicals like Gareth Soloway, trend lines remain one of the most visual and versatile tools at your disposal. If you can draw them cleanly and use them consistently within a structured system, they become a guide, a way to synchronize your decisions with what the market itself is showing. Thanks for watching. If you found this lesson helpful, like, subscribe, and leave a comment about how trend lines fit into your own strategy. And remember, trade with a plan, trade with patience, and always let the market confirm your view before you commit. Bye for now.